Hello and welcome to Module 9 of the Income with Options Masterclass. In this video, we're going to be talking about risk management. So we'll talk about the 2 rules of risk management, and then we'll talk about the rolling process of position adjustment. Now, when you go through this material, if you haven't already read the PDF, you'll probably step back from this and go, wow, this is really simple stuff here. What's the big deal? Well, if it was that simple, then why isn't everybody doing it? So once more, I will impress upon you guys that these are very simple concepts, and it's good that they're simple concepts, but just because they're simple to do doesn't mean that people are doing them right now. So I will encourage you to apply what we discuss in this module. First of all, let's talk about what everybody thinks. Everybody thinks to become a successful investor, you need some kind of a special strategy, something that nobody else is using. I think the real answer is perhaps a bit more brutal than that. I personally think that your first step to becoming a successful investor over time is not to get wrecked out of the gate. Don't destroy your initial capital before you get a chance to acquire skills and then leverage that trading edge. It'll put you way behind what you could do otherwise. It does take time to really understand that the markets don't work like a linear equation, x plus y equals z, right? 1 plus 1 equals 2, works quite different from that. Markets tend to move in a completely irrational manner. While the newer investor expects order, logic, they expect that the same things that work for them in their previous career are going to apply in financial markets. They do not. And because of that, the newer investor will continually find themselves on the wrong side of the price and the smart money. This does sound a little bit heartless, but I want the best for you, and I have to be direct about this. I have to be very honest and frank. Your goal right now is not to lose your capital stake while you learn how to acquire edge. I realize that everybody's impatient to be successful, but it is a process like everything else. It does take time to learn how to be the smart money. Just like it takes time to be a successful surgeon or pilot, attorney, dentist, whatever role that you want to assign to this. It doesn't happen overnight. If you can just slow down and apply the next 2 rules that I'll talk about, you'll do yourself a massive favor, not only now, but down the road through compounding. Let's start off with rule number 1 of risk management, which to me is responsible for the majority of blown accounts out there. I hate to be so brutal about this, but again, let's be honest about what's happening out there and let's address it instead of skirting around the issue. Define your exits before you enter the position, not after, not on the fly, not based on some feeling, not I'll get around to it someday. Define your exits before you enter the position. It's such a simple rule, yet we rush into trades thinking that we'd better hurry or we'll miss the boat. Consequently, we don't spend any time thinking about our exit, either profitable or the stop loss, which of course means that we become paralyzed should the price not move in our expected direction. We become like a deer in the headlights. We're like, wait a minute, it's not supposed to do that. So because you never anticipated that, you have no response for that, and now you're in the unenviable position of trying to figure out a live market on the fly. And this is where the whole human condition of bargaining comes into play. Well, maybe if I just leave it alone for the next day, it'll bounce. Haven't we all heard that before? Or if it magically does move in our forecasted direction, we don't know when and where to remove it. If we're in profit, we rely on what we think is instinct or feel, but it's actually more about how we feel about our position with respect to others' comments. We all look for that validation from others. Tell me what to do. Do you think this is a good time to sell? Like they know a difference, right? Nobody else knows the answer to that. So we're looking for the crowd to support our trade, and it really rarely works out well. So here's the deal, guys. Start implementing this simple rule today, not tomorrow, but today. If you sign off on this and say, okay, starting today, I will start to define my exits before I enter the trade. The obvious next question is, well, where should I put my exit? I'm just more comfortable figuring it out on the fly, right? It's this forces you to stop and think about what you're doing. So obviously the next question, where? So we talked about the different types of profitable exits in the cash secured puts and covered call modules. I'm not going to talk about those now. You know, we talked about either letting it expire or taking it off at a 50% profit, which is very conservative, those kind of things. So let's focus on how to identify a stop price on the chart. Okay, off to the chart. Now, what I'm going to talk about here should really apply whether or not you're selling cash secured puts or whether you've got covered calls into play. It's more about identifying price levels that you find to be important. So let's say that we sold down here to this strike, and maybe we sold somewhere around the 5,500 strike price for a cash secured put position. At what point would the price have to go below for you to say, you know what, I don't think this is a good idea anymore? In fact, it's starting to change polarity. And on this chart, I would say this red line here, which is right around 4,800, would represent a good level for that. So in this case, your risk is really represented by this level here, this delta in price from about 5,500 down to 4,800. Okay, let's go to the next example. So let's look for the next possible place that we could sell a put based on a pullback. Let's say that we're selling the $7,000 put on this pullback. We're selling the $7,000 put against Bitcoin at this level. We've got a nice little pullback into play. And I would say what we don't want to see is the price, in this case, going down through 6,000. This is the former low down here, which is about 6,200. If we see the price go down to 6,000, then that represents a broken trade. And so this represents our distance that we're going to define as the risk in this trade. Now, again, you'll see in a few minutes how we back that into position size, because we're going to factor in the risk. And then based on a 2% figure, we can back into the position size that we need to play for that based on what we consider the risk to be. Let's look at the next trade here. So we're going way up and we're going to go down to a pullback down here at about 10,000. So in this case, we've got a support level at 9,000. Maybe we're going to be selling the 9,000 put at this point. We're going to be selling the 9,000 put. And I would say at this point, I don't want to see the price really undercutting about 7,500 at this point. So 7,500, the distance between the two, represents our risk. Notice that as we go higher and higher in price, we tend to get more risk. So just to net out what we're doing again here, we're going to look for a level that we consider to be support, and we will sell that put position at support. But we're also going to define a risk level at which we no longer want to be in that asset. Again, the reason why we're selling cash secured puts here is that either we feel strongly about the asset or we would like to acquire more of the asset itself. So that's why we're selling puts against it. However, there's a point at which it doesn't make sense to stay in it anymore. In other words, if this came down all the way down here to 7,000, it's like we're undercutting all kinds of support here. We're putting in lower lows. And even though it might bounce, I can't guarantee that it's going to bounce from here. It looks to be putting in a reversal process. I would rather get out of it and conserve my capital. Remember, we're going to set that to a fixed risk amount, which we'll talk about next. But understanding your level of eject, right? So at the point at which you say, I'm out of here, is so important to do before you enter the position. Now let's switch over to talk about how we get into rule number 2. Here's rule number 2 of risk management, which is try to limit your loss in any one particular trade to 2%. Now, before you guys start to wave your arms in protest saying, hey, my small account at 2% would be hardly anything, right? Just understand the spirit of what we're trying to do. Maybe for you, your account size is to the point where your minimum level is going to be 5%, which is going to be more aggressive. But when I bring up the 2% figure to professional traders, they're like, are you kidding? 2%? That's way too big. We typically limit our losses on any one trade to 0.25%, or something really small. So it's going to be somewhere on that continuum. All I want you to do is to identify one risk level that you can stick with and stick with that. So whether it's 5%, great. If it's 2%, we're going to use 2% because that's kind of the industry standard here. And if it's smaller than that, if you've got more to work with, terrific. But identify one level that you can live with, that you're going to fix the risk on every single trade. Now, to get to this point, you obviously have to identify the stop first. So there is no rule number 2 without rule number 1. So if the price is up here, when we enter, we've got to identify that stop level, and we have to identify what is our risk going to be. So if we find this distance, we'll know exactly how much distance that we have to work with from what the current price is and what our stop level is going to be. And that defines at least one variable of the risk. Now we need to fill in the second one by the position size to get to that 2%. So like I said, the next variable that you have to set is position size. So once you know the stop distance and the max loss, we've got 2 out of the 3 variables that we need. Then we can solve for the unknown for the missing position size. So let's do an example based on a $5,000 account. Let's go back to the chart. Okay, so let's put what we know right now. So my account size is $5,000. So we're just going to normalize that to 5,000. And the risk, if we take 2% of that, the risk is going to be 5,000. So 5K times 0.02. And what we're going to find is that is equivalent to $100. So for any one trade, I want to make sure that the risk is limited to $100. So we know a couple of variables right off the point. Now, let's assume that I'm going to sell a $9,000 put. We're going to sell a $9,000 put on Bitcoin from the current price right here, which is 9,700 or so. And let me make my risk level on this. I don't want to be in the trade anymore when it hits or it goes below 8,000. So let's just say that my delta for that is $1,000. So $1,000 price movement, which is going to actually take quite a bit more than that, but $1,000 under my strike price, I'm willing to tolerate that type of movement. But if it goes all the way through there, I no longer want to be in the position. So we know just about everything that we have. So the distance is 1,000. The risk is 100. So what is my position size? What is 1,000 times the position size? We'll just call that S here, equals the size. And what we're going to find is that that position size is going to be 0.1 BTC. So 1,000 times 0.1 is equivalent to 100. And that's how we back into the 2% rule on this trade. So it always starts by you identifying what your stop level is. Number 1, you identify the stop level. Number 2, what you're going to do is to figure out the 2% risk. What is that equivalent to? Okay, so now we know 2 dimensions of this. The final one that we need is position size. So when we factor in the distance of the stop, the position size, and the risk level, we can fill in the missing variable there, which is that size. And again, guys, this same concept works whether or not you're working with options, whether you're working with futures, stocks, Forex, anything, any kind of instrument, you can do the same thing. It's the same process here. The very last thing that you will determine is your position size based on the risk. Can you afford that stop with a common position size? Or can you pull it down to the point where you can afford to enter that trade? Let's talk about the final element of risk management for this module, which is rolling a position. This is also known as an adjustment. Just to give you a visual, this is where we're going to be. The price perhaps is just ripping to the upside, and maybe instead of, if we have a short call, which is sitting here, Maybe we don't want to see the price just completely blow through here and then force us into an assignment condition. Remember, if you've sold a call at this point, you're obligated to sell somebody the underlying asset, in this case, perhaps it's Bitcoin, way down here. So even though the price is up here, you're capping your profits, not going to make those gains in that area, right? Those are going to be surrendered because of the obligation of the short call. So what we always want to do here is that if you want to keep the underlying asset, which I'm assuming that most of you want to do, we have to be very defensive about this. So a roll is where you close down the old position before it gets to be a real problem, and then you reestablish a new position further out in time and distance. Now, when I say a new one, I'm talking about another short call. Typically, I'm using this with more short calls than the cash secured puts. So you would want to do this if you want to avoid exercise of your short option at expiration. If we have a short call, let's say up at this level, at whatever level it is, and the price is coming towards that, as soon as the price touches that, this is typically where I will roll the position. This is where I'm actually closing down the old short call by buying it back. And unless it's right at expiration, I'll probably have to spend a little bit of money to do so. Probably take a small loss in the original trade to do so, close it down and reposition it further out, not only in distance, so vertical distance in price, but also from a time perspective as well too. Now, you don't have to do this if you don't want the asset anymore. This is a perfectly common strategy to execute with stocks where you just get called out and you get the maximum on the covered call trade and you're happy with that and you get called away, especially for a stock that you no longer want. Or in this case, if we don't want Bitcoin anymore, or if there's an asset which has options you can write against it and you don't want it anymore, this is one way to get rid of something and get paid to do so. Once I close the old position, so there's no real magic here. Once I close this one, I'm just pretending that I'm adding another offensive cycle. So I'll go maybe another 30 days out, and whatever the distance is, I'll try to get this above resistance. Or if you're going to use a delta rule, say maybe like a delta rule of 20, or making sure I get at least a 1% return, whatever my offensive criteria is, I will use the same metrics to establish the new position. So I will typically not roll the short puts. So I will do this more with the short calls. But if a short put is getting in the money like this, I'll sort of suffer through that and identify that stop loss condition down here, because quite often we'll see this pierce through there and then bounce back up again. Remember, you were making the assumption you wanted to get assigned anyway to this. So the only time that I won't do something like that, the only time that I will roll if it's not underwater is if the price is right at the short strike and I'm either going to walk away from this tomorrow with no assignment or I'm going to get assigned at that price. I might as well, if it's that close, I might as well roll it further down. And a lot of times I can close it for a small profit, set up a new trade down here for the regular target profit, give myself another 30 days, and perhaps the price wants to go down a little further. This will only help me if I'm trying to accumulate and stack sats. So in just about every case, I'm rolling out to an additional 30 days or so and establishing a strike price following the same offensive criteria as before, just like if I was entering a brand new trade. Same thing. Okay, that concludes risk management. In the next module, we're going to be talking about summarizing the entire program. So how do we take this thing from start to finish now that you've gone through all the material and apply a plan towards this, which is going to assure success going forward? We'll get to that in the next module. See you there.